to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Madan Sabnavis, Chief Economist at Bank of Baroda, joining in. Welcome to the show, Madan, and always a pleasure to speak to you and get insights from you. Madan, my first question coming to you is overall with what's happening in terms of Russia-Ukraine as well, how big an impact it could be in terms of the Indian economy, firstly?
See, if we're looking at the impact of the Ukrainian conflict on the Indian economy, I think we need to separate two parts. One is the market impact, and the second is the real impact. Now, looking at a market impact, we have seen that all the markets, that is, you look at the stock market, the bond market, and the currency market, all of them have been impacted on account of the developments which are taking place almost on a real-time basis. So we've seen the sentiment changing in the stock market based on whether there is a truce or a possibility of truce out there. That's one. If you look at the bond yields, they have generally been a bit jittery. Now, Indian has been quite different from other countries because if you look at the 10-year bond, for example, in almost all the developed countries, we have seen a sharp increase in these yields. Whereas in India, I think because of the operations of the RBI, more in terms of the RBI talk, it has helped to keep the bond yields more or less stable in this region of around 6.8 to 6.9%. In terms of currency, I think ideally there should have been a sharper depreciation than what we're seeing, but we're seeing a largely stable rupee, primarily on account of the fact that RBI has had a big role to play. They have done already $5 billion of swap option, and there's another one coming up in April. So I think that itself has sent a very positive message to the market that the RBI is here to ensure that there is less volatility in the market. And therefore, we have seen the rupee being more or less range bound in this region of around 76 rupees to a dollar. Now, in terms of the real impact, when I talk of real impact, I'm talking of how GDP growth will be affected. I think the impact is going to come through the inflation route. But I think that has been one variable which has been troublesome and irksome for all of us because we have seen that inflation has gone up on account of not just oil prices going up, but also because of global commodity prices, which is both in the area of metals as well as food products. When I say food products, it's in the area of edible oils, which is already a pain point for us. So I think on account of higher inflation, there is a possibility, in fact, I would say it's a distinct possibility of overall purchasing power getting eroded, and the discretionary consumption expenditure is going to get impacted, which will have an impact on overall GDP growth. Not very significant is what I would say as of now. Maybe growth projections could have to be tempered by around 0.25%, but nothing more than that as we speak today.
Right. So overall, with all of this said and done with what's happening globally, how are you viewing the growth momentum in the domestic markets? Because it seems that the sequential momentum is starting to slow down. The early data that we saw for the month of February as well indicated that almost around 59 to 60% of the indicators were still in the positive territory. However, the final data for Jan is indicating that 66% of the indicators have been in the positive territory. But overall, are we seeing that sequential momentum slowing down and there's a possibility that the growth could hit a wall?
No, I would be a bit more optimistic out here. I think things will start looking up. I think there's a lot of uncertainty in the months of February as well as March. So today there is a little more certainty, even though I'm saying that none of us know what's really going to happen, but we know what is the worst possible case scenario. For example, we were at one point of time talking of crude oil going to $150 per barrel. The USSR, or rather Russia, had spoken of oil going towards the 400 mark in case there was a total embargo on exports from Russia. We also know about what could be the retributive action which could be taken by the Western nations, that is in the form of sanctions. Now, everything is more or less well placed. And I think this kind of a war is not something which can go on because I think the economic burden is high, not just for Ukraine, but also for Russia. So to my mind, it's only a matter of time. This matter of time could be 15 days, could be a month or 2 months, but definitely the intensity of conflict has come down. And there is more certainty that we will not have anything more than the sanctions. Crude oil will remain in a triple-digit range, but definitely it will not be going up to $140 or $150 per barrel. So I think that level of certainty will definitely help to improve economic activity. Though we should accept that the beginning of any particular financial year tends to be slower. So we would be getting mixed, conflicting signals, and one could probably jump to a conclusion in the months of maybe April and maybe even May that things are not really looking up, and that would be more a case of seasonal factor rather than the war factor.
Right. And overall, if you see in terms of the rural unemployment as well, that has risen, overall. However, rural wages have slowed down. Plus, if you see the urban unemployment, that has started to decline. So, what does this data actually signify to us from here on?
So I think employment has been an issue even before the pandemic, and employment is definitely dependent upon the overall growth process in the economy. So I think people employ people only in case there is work to be done, there is production activity, both from services as well as manufacturing. So I think the clue will actually be as to how exactly do we get our investment and growth prospects on track, because that is something which is going to lead to an increase in demand for labor. So both in terms of rural as well as urban employment, I think the focus will have to be something on the private sector. So this is not something which I think the government will be able to turn around. The government provides an enabling environment for economic operations to take place. But ultimately, I think the private sector, when I say private sector, it's not just a corporate sector, it could also be the household sector. We need to see businesses actually picking up. And here I think the problem would be again inflation because of high raw material costs coming in the way at the margin, especially of the SMEs, if I were to select a particular segment, could actually come in the way of generation of jobs, as their output even today has been stifled to a large extent on account of the Ukrainian conflict, because they are the major exporters. So even though the amounts may not be large, but in terms of value, but in terms of the number of units which are affected is definitely considerable. And that is something which we need to see how it pans out, because I don't think there is an automatic solution for it.
Right. And overall, if you see in terms of the current account deficit as well, at 2.7% of the GDP in the third quarter, and the first half FY23 borrowing at 59% of the budget, uh, yes, it's marginally lower than what the street was anticipating. What's your view? Do you think one, it's on the back of a higher trade deficit and that could continue?
So in terms of current account deficit, yes, it is the trade deficit which is contributing to it. And to a certain extent, I would say that your invisible flows could get impacted on account of the war conditions, which especially if you look at remittances, not so much of the software, that will definitely get impacted on account of what is happening globally. But otherwise, I think it is the trade deficit. So I think as we like to be very happy of the fact that our exports have touched the $400 billion mark, unfortunately, every time our exports grow, imports tend to grow at a faster rate. It's probably a positive sign. If it's the non-oil imports growing, it really means that more raw materials and intermediate goods are being imported, which is supporting the growth process. So that's a positive sign. But in terms of the external account, we would tend to see that the current account deficit will be pressurized. In fact, we can be expecting the fourth quarter of current account deficit to even cross 3% mark. And maybe even in fiscal 23, the overall number is, in our estimate, would be more in the region of around 2.5% for the full year, assuming oil remains in the region of around $90 to $100 per barrel. So there's some correction. I think that's going to play a very critical role in terms of influencing the current account deficit.
Right. And overall, with that as well, if you see in terms of the balance of payment surplus as well, that has been on nil on account of the portfolio outflows that we've seen, as well as a slowdown in the FDI flows. That's down by almost 70%. How big of an impact would that be?
No, I think that's a serious concern, because we're talking of a situation where there are warlike conditions, number one. Two, we have interest rates in India which have been held back from increasing for quite a long period of time. On the other hand, we have seen the Federal Reserve already indicating and starting the increasing of interest rates. The same thing is going to happen. The ECB, the Bank of England has already done in an aggressive manner. So definitely in terms of foreign investors, the alternative markets would be something which they would be considering. And I would tend to believe that both FPI and FDI would be slightly more low-key in the coming year, including FDI, I would say, essentially because of the fact that there are growth opportunities in the developed countries, which are also trying to get the economies back on track. So even FDI is going to get affected, and I think FPIs hopefully should be in the positive territory, but even if it's in positive, I don't expect it to go beyond $10 billion as things stand today.
Right. And additionally, with this, Madan, the CAD is expected to widen, plus you have the portfolio outflows. And with high forex reserves probably serving as a buffer against the sharp depreciation, do you expect the rupee to trade with a depreciation bias?
So actually, to my mind, I think we should allow it to trade with a depreciation bias. But the kind of intervention which we have seen from the RBI, not just in terms of the swap, but also in terms of the interventions in the market on a regular basis, both in the spot as well as the forwards market, to ensure that there is less volatility in the market. To my mind, I think the rupee may probably still trade at 76, $77 rupees to a dollar, though I think we should ideally let the rupee find its own value so that to the extent that our exports can benefit from it, there will be a price advantage. Now, I do admit that it's very hard to put a number to it because normally every time there is a depreciation which is permitted by the RBI, it becomes self-fulfilling, and the market forces work such a way that exporters keep their funds out, importers rush in to book their imports, and that itself exacerbates the condition and leads to a demand-supply mismatch, leading to further depreciation. So I think it's a very, very ticklish issue, but I think the RBI is probably doing it in a very gradual manner. And one would expect that once the war conditions do ease and things are better, the RBI will probably be less aggressive in the market than they are today. Because currently, I think they're giving you the markets a signal that the currency market is stable, the bond market is stable, so there's nothing much to worry about. Inflation, of course, is beyond their control, but they have been talking about inflation, so it'll be interesting to see what they actually say in the policy on inflation.
Right. And do you think the fiscal deficit for FY22 may see a marginal slippage? Because clearly, if you see the divestment, we have fallen short on that front.
I think in 22, we may not actually fall short because looking at the numbers till February, there have been certain expenditures, including capex, which has been running slightly slower than earlier. So it's quite possible that the government may cut back on certain expenditure to make sure that the fiscal deficit is kept under check. To top it all, we've also seen that tax revenue, general revenue tax and non-tax revenue, has been slightly more buoyant than what was expected. So I think I won't be surprised if there are some savings that come in and we may have a slightly lower fiscal deficit, but I definitely don't think there will be an increase in the fiscal deficit. And it will be done through a combination of expenditure cuts, both in terms of revenue as well as in terms of capex.
Right. And overall, in terms of bank credit growth as well, a lot of expectations are, Madan, on a double-digit growth. In fact, earlier when we spoke as well, we've said that clearly, yes, if nothing better, but lower double-digit growth could be possible. Do you see that as an option yet?
Yes, I think we would still maintain that growth in credit in 22-23 will be in the region of around 10 to 12%. Again, something like 8 to 10% in the fiscal 22. And this is based on the premise that we do expect certain industries, especially on the infrastructure side, to show signs of higher investment, which will mean higher borrowings from the banking system. It may not be very well broad-based. At the same time, I would feel that even things like retail credit would continue to grow in the normal manner, even though we are expecting the RBI to increase the repo rate by at least 50 basis points in the next financial year, which would mean that the costs would go up. So that could be something which we have to see as to how individuals do react to higher interest rates on their home loans, because currently they're prevailing at very, very attractive rates, 6.25, 6.5%. In fact, the rate for an individual seems to be better than what the government is doing when it's borrowing from the market. But I do expect that it may not be very well broad-based, but definitely growth in credit will remain fairly stable and slightly higher than that of last year. That is of fiscal 22.
Right. And very lastly, Madan, with regards to the RBI as well, in the next meeting that will be slated, how are you expecting them to react in terms of interest rates, in terms of their stance, etc., basis what the global central banks are doing right now as well?
So I think the RBI has always maintained that policy in India keeps in mind what's happening globally, but it looks more at domestic conditions, which I think is the right way to go about it. Because finally, at the end of the day, I think we are influenced by domestic inflation rather than global inflation. Now, what I expect the RBI to do is definitely what I would be looking out for the RBI to do is what kind of signals are provided on both GDP growth as well as inflation. Now, why is this important? This is important because last time the RBI said we're still not sure about the durability of growth. They're given a projection of 7.8%. They had spoken of inflation of around 4.5%. And the view taken was that the higher inflation numbers, which we were seeing on a monthly basis, was more transitory in nature. Now we'll have a very unique combination. A, growth prospects to my mind will be lowered. Now, how much lower is of course a matter of guessing, but it'll be lower than the 7.8% number. If we're talking of inflation, it will definitely be higher than the 4.5% number, which means that there's going to be a dilemma for the MPC, because we're talking of low growth, higher inflation, which seems, and inflation is going to be more of a permanent nature. I think now we cannot really say, with 2 years of over 6% average inflation, we cannot really take the view that inflation is transitory. So under this condition, I think some view will have to be taken, some action has to be taken on interest rates. Now, what will it be? Maybe the reverse repo increase. I think last time the RBI said that the effective rate was anyway around 3.84, and most of the funds are going at 3.99% in the term repo, reverse repo auctions. So therefore, there may not be a case for actually increasing the reverse repo rate, though that would be a good signal to be given. But to my mind, there could be a change in the stance of the RBI from an accommodative to neutral policy. That will be a very good signal to the market. But not saying anything, not doing anything will actually leave the market confused, because today we have a case of saying there are war conditions, Federal Reserve is increasing rates, foreign investors are not coming into India. At the same time, we have lower growth prospects, higher inflation, and the RBI cannot say that nothing has changed since the last policy.
Right. So overall, my last question on that is, a lot of industry players are feeling, Madan, that a sub 6% average inflation could probably even give the RBI leeway to have some policy flexibility. However, do you think there is a possibility that the central bank might have to pay a bigger price for ignoring inflation by tightening interest rates much more aggressively later, like the Fed?
Yeah, I think that's the thing. So I think we will have to start off right now by taking some action on the interest rate front, because I think the markets know very well that this inflation is entrenched. So we need to take action to ensure that we don't have to hurry up, because the 6% number can actually spiral to 7 or 8%. So it's, I think the statistical bases have always been favorable for us. Therefore, it gives us this feeling. And I think the way in which we economists tend to mess up things by talking of core inflation and core inflation, you keep splicing up the entire number to show that maybe everything is all right. But the fact remains that the headline number is increasing. Most of the components are going up. Most of the manufactured goods, services sector, all of them have started passing on the higher costs in raw material costs or the input costs to the consumer. And there's going to be a second round of higher raw material costs, which is going to be passed on. So I don't think it would be right to not take any view on interest rates at this point of time. We need to send some signals and then start the baby steps of increasing the repo rate, because we can't be living with such negative real interest rates for such a long period of time.
Absolutely. Very well said, Madan. Thank you so much for joining us on the show and always giving us insights and forward-looking views. Thank you. Stay safe and speak to you soon again.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.